Good morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi, Nikunj Dalmia, Avan Dabash in the studios. And, before we talk about the market, what all has happened from when we actually saw the closing bell up until this morning. Firstly, the global handover, it's a bit of a mixed bag because while you've had the tech-heavy NASDAQ sell off quite a bit, about 2% of the cut coming in, Dow has been okay and Asia is just about a bit of a mixed bag as we speak, largely in the red. But the SGX Nifty or the GIFT Nifty at one point in time was indicating a 100-point downtake. From there, it's made a meaningful recovery. For our markets, we were just about 30 to 20 odd points away from the 20,000 mark yesterday. The August and September Nifty futures have already made it to that mark. But I think the big spoiler today is going to be Infosys, the guidance cut, and that's going to be a howler on the street. And I think the bigger question, Nikunj, today is, can the index do it alone without the support of IT? Because I don't think it'll be just an Infosys-led story. The rest of the IT pack also may fall. But can HDFC Bank, ITC, Reliance take the Nifty higher?
Especially with a weak handover from the global markets.
No, look, you got to ask yourself that we are up 6 days on the trot.
Yeah.
And what has really led to that uptick? The helping hand from IT was not there. It was largely the special situation stock which Reliance had become.
Yeah, even yesterday IT was falling.
Exactly.
Yeah.
So it was because Reliance had become a special situation stock. ITC is now acting like the engine stock. And then you got a smart follow-up buying which is there in financials and especially PSU banks. So if you frankly ask me to understand the market from the prism of what happened yesterday, and I throw in that caveat of HUL versus HUL and ITC, well, there's an L&T buyback also, we are forgetting that. So that is a bit of a good news. So if I put all those three together, you may argue that the market could really hit a pause button, or markets may really choose to consolidate. For me, more than Infosys, I guess it is that Reliance price discovery magic which supported benchmark indices, that would be missing, and then Reliance numbers are today. So the moving part in the morning trade would be Infosys. The moving part, at least for second half of the trade and for next week, really would be back to Reliance. My sense is, if you are looking at the day, like we discussed, can markets overlook the Infi fall? Point number one. Point number two, if we have to go past 20,000, will it be a combination of ITC and L&T now? Because Reliance will take a backseat, will banks chip in? And third, why is the market breadth looking slightly rusty? These are the three factors which really would be at play. So in terms of a strategy, just because Infosys numbers are bad, you don't short.
Yeah, absolutely.
Yeah.
Just because Reliance special situation, that price discovery had happened, does not mean markets will peak out. The strategy is simple. Stick to your longs in large cap stocks. Be choosy in mid cap stocks. And I think the craze in the small and mid cap stocks now, you can feel that a lot of mid cap stocks are hitting a pause button if they started retreating. So you go to ask yourself that, was really IT doing the heavy lifting? The answer to that is no.
Yeah, absolutely. But, here's a fun fact. The current rally of the Nifty has actually 51 stocks since yesterday. And India may have received most FII flows, by the way, among emerging markets year to date. But Nifty is not the biggest gainer. If you were to stack up how other emerging markets have fared as opposed to us, so while we have had a large chunk of the FII flows, the market returns have not been as high. And yes, the stock with the biggest weightage, that's Reliance Industries. Guess how much has it gained year to date, Nikunj? Don't look at the graphics.
No. You have to add back the 200 rupees. 260 rupees
Even
for
if you
Jio
add that
Financials.
back.
It would be flat.
13% only.
Yeah, just nothing. And then you add back that 260 rupees, then of course the gains would look slightly gangbuster. It hit by the way, technically you can talk about Reliance Industries, is a hit a new all-time high.
Yeah.
So that's the point, Aisha. We may be at an all-time high, but the market in this year has not even registered double-digit gains. Second, valuations. So see, this is a liquidity-driven rally. And in a liquidity-driven rally, you've got to be cognizant of what the flows are. Have the flows reversed? The answer to that is no. Are flows likely to go to mid and small cap stocks from global investors? No. So then if flows are strong, if markets have not really reached what could be called as a bubble zone, then I don't think you should be preempting some kind of a sell-off. And I just want to make one more point, and we'll move to Infosys after that. The valuations. For those who are coming and buying India right now, they're not buying India at a very fat premium. Indian markets by and large are still in and around their 5-year premium. There you go. 5-year average, 19.3 times. Nifty is now trading just a shade above the 5-year average. So we are reaching that premium level now, but we are not there yet, which means there is still some more fuel left in the tank. All you need is a little bit of support from earnings, and we'll talk about it.
But that's not quite what we got, at least when it comes to the IT sector. So let's discuss that in greater detail then. And here are the key takeaways. The fact that there have been ramp downs and that's led to weak revenue growth pretty much across the board. There's been a reduction as well in headcount. In terms of onboarding and increments as well, delays have been witnessed. Most of these IT companies as well, in terms of the road ahead, have been non-committal about recovery. Although the deal wins have been strong, the pipelines have been strong, the focus on AI, digitization, etc. as well has been strong. And if you were to just look at the guidance, the forward-looking commentary from some of these IT majors, a lot of the heavyweights like TCS, Wipro, Infi, and even an LTIMindtree have trimmed their guidance. It has been maintained by the likes of L&T Tech, Coforge, a Mastech, or even an HCL Technologies. And, Nikunj, as part of your commentary about where do we go from here, do you think that this disappointment and these weak numbers, the markets can really overlook it, particularly for IT?
So let's divide it into 3 parts. What's happening in Infosys, it's more like an howler, horrible, terrible, and pathetic set of numbers. Now, Q1 numbers were in line with estimates, but the guidance is where everybody's surprised that why is Infosys not able to gauge and judge the business environment, because for 2 quarters, for a company which had mastered the art of always promising, under-promising and over-delivering, in this case, they've gone wrong, absolutely, sir, for 2 quarters on the trot now. The implications of that, well, that clearly means that if one of the bellwether sector, one of the bellwether company in the IT sector is struggling to find visibility, then that obviously means that there is a fog on the windscreen for the IT sector per se. Now, specifically with Infosys, I think this is also a company-specific problem, which I guess will accelerate the fall. The ADR last night just plummeted, like a 10% plus fall for ADR. So if the ADR logic is anything to go by, the stock will see a gap down, and I will not be surprised that the pressure could continue for next couple of days. Bear in mind, Aisha, Awan, we were discussing this yesterday, that the stock post the TCS run-up had seen a run-up. The 52-week low for Infosys is sub 1200. It is not 1400. So it is fairly, it has seen a charged up move in last couple of days. The question you got to ask yourself is, okay, these are bad set of numbers. Stock will be down by 10%. After today's decline, the decline may well extend itself into Monday. Do you buy Infosys? Now that's a tricky call, because after a 12-13% decline, according to the Jefferies report, the stock will be trading at a discount to its 5-year average. Now that's a call which only long-term investors should take. But today, I guess Infosys will have a collateral impact on the Nifty per se. I think it's a company-specific issue. The problem, what will happen, Aisha, Awan, according to me, is that there was a little bit of change of heart, that where is contract value in this market, and that appeared in IT post TCS numbers. And when you get this kind of a commentary from a bellwether stock like Infosys, which in a sense, like I said, they have a reasonable track record of under-committing and over-delivering, then it just makes you wonder that jo Infosys mein ho raha hai, what is the guarantee it may not happen to other companies? Sooner than later, will they also be admitting the same thing?
Yeah, let's ask that perhaps to Moshe Khatri, who is joining in on the show. Hi there, Moshe. We're just, assessing the damage really that we could potentially see in Infosys post the commentary, as well as the weak set of earnings. What do you make of it? And do you think that, this sort of messaging could play spoilsport down the line for IT as a whole?
Well, good to be here. We're in a very unusual kind of situation right now for the industry, because as you suggested a minute ago, you're definitely seeing large deal flow coming through the pipeline. Companies are winning large deals. So that's on one hand. But as we understand, a lot of these deals are not ramping immediately, and some of them may ramp a few quarters after being awarded. And I think that's impacting everybody's visibility. I think there's a lot of criticism about Infosys guidance, that it was revised months after the original one. But if you look at the,
Okay, I think we got Moshe on a very bad line. It's raining in Bombay. When it rains, it pours. I mean, just bear with us. Moshe, why don't you hang in there if you can hear me, and we'll just dial you back right again on a new line. Just a little bit of audio drop, I guess, at least at our end. Where's the ADR? Can you look at the ADR, please? Okay, ADR was down more than 10% last night. That's what I can share with us. We'll try and also flash on the ticker.
It's interesting, Nikunj, what Aisha was just alluding to a while ago, the fact that, there has been a healthy project pipeline, the company has been winning new orders, and still when it comes to, the near-term revenue outlook, they're saying that looks challenging.
See, what may have happened is that when you get deal pipeline, these are multi-year orders. Yeah. They may just take time where you may, it's like you get an order to make a ship. The ship will be delivered in 5 years, 10 years in this case. So some of the order books may have a lag impact, and that's what Infosys is saying, that the second half should be potentially better, but we do not want to commit right now, because as of now, it's like we've been non-committal. Whatever we've assessed about the situation 6 months ago, we've gone wrong in it, so we do not want to commit anything. As of now, this is where we see visibility. However, there is a silver lining that in the second half of this year, you will see recovery. So the question now, Avan, Aisha, is that there is no point in discussing that why numbers were bad. The question now is that what do you do after today's fall?
Exactly.
And after today's fall, Moshe, I think that's a broader point. Look, whatever could go wrong, whatever can get right, that's the environment we are in. As an investor, after today's fall, it could be 5 to 10%. Should one be buying Infosys?
all right, can you guys hear me?
Yes, please. Good morning again.
Hey, good morning. So I'm gonna just go over what I said before the reception was lost. We're in a pretty unusual situation where you're seeing large deal flow coming through the pipelines. Companies are winning these large deals. That's on one hand. On the other hand, these deals are not ramping on the spot. And in certain cases, it takes 1 or 2 quarters for that to ramp. And that's impacting visibility for everyone. In terms of guidance, among the 4 large tier 1 offshore players, only Infosys and HCL Tech provide annual guidance. Wipro and TCS don't. So it's probably difficult to kind of know whether this is an Infosys specific problem or not. But you can probably kind of argue that there is an issue with visibility, and there's also an issue with the fact that deal flow is not ramping and not converting immediately. And I think that impacts any sort of hypothesis that the second half of the fiscal year is going to show an improvement in revenue growth.
Moshe, to the point that we were, that we brought up with respect to what one should do now with Infosys, given the fact that they have acknowledged that it is going to remain soft, or it is going to remain challenging, non-committal when it comes to the guidance down the line, what should one do ideally?
I think calendar 23 is a transitional year for the sector in general. That's how I kind of look at it, and that's how I treat it. If you get that bump in the second half of the fiscal year, that's fine. If not, I think at this point, as a long-term investor, you're starting to look at next year's numbers anyway. So, on a relative basis, I don't see any catalysts for the group for the next quarter or two. And then, you do have to make certain assumptions about the next year, next calendar year. Is macro going to look better? Is it going to get worse? And obviously that impacts spending and spending intentions by enterprise clients.
To the point that we were earlier wondering, when is it that you become a buyer in Infosys? Because today a gap down is given. We're currently, if we can just bring up the stock price up for Infosys, we're currently around, even after yesterday's fall of 2% let's just bring up that stock price and show you where we're currently at on Infy. We're around 1440 odd levels. Historically, we've seen that the stock always, bounces up from those 1200 thereabout levels. When do you become a buyer in Infy?
I think again, we cover the ADRs, so somewhere in the mid-teens, that's probably a good level to start accumulating the stock. And obviously the stock had a pretty nice move since TCS reported. I think that, stock was up about 15, maybe 16%. And it kind of came back to where it was before TCS reported. So it probably sits here until we get better visibility for the next quarter or two, and then, potentially kind of goes on an uptick. Look, these deals ultimately will get converted. The question is when. And I think that's really, it's all about timing at this point.
Also, then, Moshe, what happens to the average differential? I mean, the premium that historically TCS has commanded over Infy, does that gap only get widened?
Well, it's a good question, because remember, TCS does not provide annual guidance. Infosys does, and Infosys clearly is getting penalized because of that. So the response to your question is probably going to be, let's see how the next quarter is going to be for TCS. I'm assuming what Infosys is seeing in the long run in terms of visibility challenges is impacting everybody. And if you tracked IT services in the US today, you've seen almost every single name down anywhere between 3 to 10%. Obviously, 10% is Infosys, right? The only name that wasn't down in the sector, and it's kind of a hybrid, is IBM. IBM was up 2-3%, just because people are looking at this more as a kind of safety kind of vehicle to be able to hide in. So I think the entire sector is going to have visibility issues, and probably in line with what Infosys is actually talking about.
So much, Moshe, for putting all of those details into perspective. When it comes to IT and Infosys in particular, those will be stocks on our radar today. But let's find out which of the stocks on our technical chartist radar. Naresh Mirani is joining in. And Naresh, what a day it was yesterday. So close and yet so far from that 20K mark. After yesterday's wrap up, about 146 points higher, and the kind of volatility that we witnessed, the fact that there's no support coming in from IT or the global markets for that matter, where to from here?
So overall, if we look at it, we need a pause. We've made a move from, say, 19,500, 600 levels, which was the previous high, towards almost 20,000. And we've had this 500, 600 pointer moves, then a pause. And as continues, we saw a pause at 17,400, 17,800, 18,600, and so on and so forth. So a pause from here would be an ideal case for the market, so that the market continues in a trend. So for now, 19,600 becomes a zone to watch out for. That is where the previous top is. So 19,500, 19,600 is a zone. And overall, 20,000 should now act as a resistance. Now, given the fact that IT will see a gap down and the whole sector has less than 20% weight on the index, we could see an impact coming in from that name itself. But at the same time, if we look at what is happening with the rest of the constituents, we are seeing Reliance Industries hit an all-time high on an adjusted basis. ICICI Bank hit an all-time high yesterday. SBI is 2% away from an all-time high. Axis Bank has gone nowhere. We've seen Kotak Bank make a move. So overall, the rest of the constituents still look okay. So some bit of a pause needed, and we should get into this pause over the next few sessions.
Okay, so Naresh, clearly not IT. What is it that you're betting on? What are your long calls this morning?
So going a little defensive here, looking at stocks which are making fresh moves or have gone nowhere for some time. First is a buy on Grasim, which for the last many weeks, 1800 was a resistance. The stock has been around that 1750, 1800 mark for the last few weeks. Yesterday was the day where it crossed about 1800. So expecting there should be some follow-up move here. A stop loss at 1770 and a target price of 1950. Second is a buy on Gale India, which has just consolidated for the last few weeks. 111 to 113 is a resistance. That is where the previous all-time highs are also there. The stock came into the touching distance yesterday, also coming closer to 111. And the stock has spent a lot of time in this range. Could be a major breakout once it sustains above 113. So preemptive buy here, stop loss at 107 and the target price of 125.
Okay, let me welcome on board Kunal as well. Kunal, 20 points away, and that looks so far from that 20K mark. I don't know, maybe today IT could be the spoiler, but do you think the index can do it alone, considering yesterday too IT was not participating and it was all about ITC, SBI, and of course Reliance?
So good morning, Aisha. I believe maybe a couple of days of more rest for the indices, because after the reaction which you've seen over the last couple of days, even the IT stocks, large cap names over the last 2 days specifically, were taking a bit of a pause for themselves. TCS, HCL Tech, even the likes of Infosys, for example, retraced mildly from its previous swing highs. So I think in that regards, maybe the markets were anticipating that the IT could take a bit of a pause. But the banks yesterday managed to make a very strong offset gain for themselves, because the likes of ICICI Bank coming closer to that 1000 mark, Axis Bank, Kotak Bank, we saw very good recovery for the stock. So I believe that maybe today could again be a day where the markets may offset the losses which could potentially come out from stocks like Infosys to maybe banking names or other large cap stocks. So I think that's the balance which we are looking out for, to try and see that which are the sectors which try and gain when the index is looking a bit more concerned over the IT stocks. But I would largely believe that we are still traded quite well. We've consolidated in a band in the last couple of days. We managed to make a new swing high. We came very close to that 20,000 mark. The sector composition was also quite vibrant. The market internals was also quite attractive. So all of that looks to be positive. Would expect the indices to consolidate for the next couple of days. Hopefully, once the balance gets set, we could be making a dash back again towards the 20K.
Right. So Kunal, tell me about your stock ideas as well.
So two buy calls. The first one is about Axis Bank. As I mentioned that we saw a lot of private sector banking names making a good comeback. Axis Bank is something which I would suggest as a buy. 1010 as a target. Stop loss could be kept at 960. And even Sun Pharma from the large cap pharma stocks made a fresh breakout. So the stock has earlier broken past about the 1070 barrier, and now yesterday it crossed about the psychological 1100 mark. So would expect a rally to continue for Sun Pharma. Targets of 1130. Stop loss at 1082.
Okay, let's talk stocks and all that's going to impact your trading day today. Of course, IT is going to be top amongst all that watch list, and we've already given you a perspective on how you should be looking at trading IT this morning and what's the call really on that sector. But Anisha, ABB as well, especially after the group anticipated lower revenue growth for the current quarter.
Yeah, but I think it's ripe for a rebound today, because I think the knee-jerk reaction that we saw on the stock yesterday was quite exaggerated. That 7 to 8% cut wasn't really warranted, because there isn't a very bleak picture that the group is actually painting. Just let me start with what happened yesterday. We saw that the stock slid by almost 8% ABB, and that is when the ABB global parent had actually reported numbers. Remember, for calendar year 23, they haven't changed their guidance as such. They are continuing to maintain a double-digit growth. So 10% kind of growth is what Street is penciling in. And in fact, they've raised their operational EBITDA margin guidance to around 16%. Now, what was the read-through for India? For India, they talked about how the order inflow was up around 7% on a year-on-year basis. Now, that translates to around 2,960 crores, which is 8% ahead versus Street estimates. At least that is what Macquarie has to say, that it was 8% higher than their own expectation. In fact, they said that in the last earning calls, the management of ABB India had guided that the order inflow in this year will be higher by 12 to 15%. That means a run rate of almost 3,000 crore per quarter, and that is exactly what seems to be coming out of the earnings of parent as well. So there's no reason for a big cut that we saw yesterday. But Nikunj, as always, the stocks like ABB, etc. continue to be very expensive, 60, 70 times. But given the fact there's stability, there's this entire, push around manufacturing, industrials, capex, do you think it's ripe for a rebound?
Look, it's rise with India, right? I mean, what's happening in the world is not happening to ABB, even though it's a global company. 60 times, you go to buy the stock when there is bad news. You don't ride the stock purely for momentum and purely to make large gains. Do
you buy on this bad news is the question.
Aisha, at 60 times, I think you need to wait for a fall if you're really looking at fundamentally buying it. And my general view is that, look, it's a matter of time that if the global business cycles are changing, it will start impacting India. See, India also is looking at manufacturing, and it will have an impact if the export business slows down. While we may talk about, that, okay, in India, the capex cycle has started, but in the globalized economy, if the global businesses are slowing down, it will impact the core business of ABB India. And my another concern, which I'm purely speaking out of experience, is that the closer we go to the election cycle, there would be delay in decision making, something which nobody is talking about it right now. I guess another 2 quarters or so, then the whole market and the whole decision making, at least in large projects, will get into wait and watch mode. We've not reached there yet, but we may reach there yet. So global slowdown, India business so far looking good, but expensive valuations will not come to your rescue if you have a stock trading at 60 times.
And that could be true about the rest of the space as well, right, Anisha? Because Siemens is the 5-year average is 46 times, it's at 61 already. Cummins 27 times 5-year average, it's at 40 already.
Yeah, but these stocks just continue to trade at a premium. Like they haven't come down below that 45, 50 times ever. So, I mean, there's a reason why they command the premium.
Why
and
do
to
they
your point,
command the premium? Let's understand that. Because they don't have debt.
Correct.
They enjoyed benefits of operating leverage. B, the order book visibility I think is extraordinarily strong from them, and they get a lot of IP in terms of technology. You know, for example, the technology what a Siemens has, the technology what an ABB has, other IT companies cannot replicate them. But for that, you playing them 60 times. My limited point is that for next 6 months or next 1.5 years, what is that trigger? So I think at best these stocks should get into sideways consolidation. These are stocks which again are clearly overweight right now, and these are not, you know, capex is yesterday's theme. It is not tomorrow's story. That is my limited point.
Sure, no, and I think to your point about, you know, the order decision making slowing, I think that's already happening with the commentary coming in that the short cycle orders are a bit sluggish, and that is what ABB India was banking on, because the short order cycles is very easier to churn as well. But Nikunj, then do you believe there is a case that, you know, people would not want to pay the 60-time premium for the likes of ABB, Siemens, and perhaps look at an L&T? Now there's this fresh trigger also happening with respect to the buyback. Of course, they attempted it back in 2019 as well, and that failed because of the norms at that point. But now we understand that there is going to be a meeting on July 25th wherein they are going to consider a special dividend or a buyback. Street is penciling in a number of around 10,000 crore, and Axis Capital, for instance, was saying this is not a one-off. Perhaps this is going to continue because the cash generation cycle has improved tremendously for L&T.
Look, you know, when a company like L&T, which essentially is a business which is in defense, capital goods, and also IT, when they're considering a buyback, and when you consider a buyback, that means that you're very confident about your cash flow.
Yeah.
When you're confident about your cash flow, that obviously will lead to re-rating of stock in the short term, because markets are nothing else but they always look at future cash flow to discount a stock price. So if given an option, a flip between ABB and L&T, well, let's move out of ABB, guys. Let's move to L&T. A flip between ABB and L&T, I guess it's a no-brainer right now. Also, if I look at the numbers, you know, Anisha, from LT, Mindtree, and also what we got from LTI Infotech, they're not that bad. L&T Financial Services, we also know that they're looking at restructuring the entire business. So the subsidiaries are also doing rather well. Cash, a buyback, cash flows improvement, businesses doing rather well, and subsidiaries firing full cylinders, and valuations not at 40, 50, 60, 70 or 80 times. That makes it like a perfect buy.
Yeah, and defense and other cylinders are also firing, and whatever was non-core, they've already exited. Quickly, you know, Nikunj, if I can get your view on cement as well, because, you know, there was this entire hope that there's going to be an improvement in margin, the costs have come down, coal prices, etc. The initial indications coming in from the likes of Dalmia Bharat, etc., are not pointing out to that. Because if you look at Dalmia Bharat's performance, of course, the volume were on the lower side, but there was a bit of a miss on the operational side as well. The costs remain elevated, and that's why on a sequential basis, there was a bit of dip when it comes to their, you know, profitability per ton as well. Do you think that entire thesis, Nikunj, that Street had about complete rebounding of cement is out of the way? As it is, it's a weak quarter. Monsoon is seasonally weak. The price hikes that they were talking about, they weren't able to absorb it fully. Of course, today we'll get Ultratech cement numbers as well. But yesterday also, when the market was doing all right, cement stocks were on the back foot.
See, you're absolutely right. The premise for cement in the last quarter was that coal prices have come down.
Yeah.
And coal is an important raw material. B, transportation costs were under control. Largely that was not under control same time last year because fuel prices went higher. For cement, there are two variable costs. Cost of raw material, which is coal, and limestone. Limestone is okay. Chuna, right? But
and they have backward
integration.
And all of that.
Coal is something which you can't control. And transportation cost is something which you can't control. And the sector got a massive re-rating after the Adani deal. So now the realization is that the input benefits have not kicked in. That's what you can judge from a number. And Dalmia Bharat is a big company. Yeah. It's not like a small mid-cap stock. It would be what, number 4, I think. Yeah, it would be number 4. 4 or 5, right? I'll have to look at the numbers. If they've disappointed, so that will apply for the entire sector per se. And then you're talking about monsoon. Well, monsoons have got extended. Yeah, and monsoons have been very erratic. And it's like it is raining in north. No construction activity when there is water on the road. Bombay, every year it happens, but monsoons have got delayed. So I think monsoon may well extend themselves beyond July, end of August. That means in this quarter also, the construction activity which stalls and then picks up after July, that may not kick in. While the big picture is always right, you know, roads, buildings, everything is great for cement, but hello.
Yeah, we suffer that every year, don't we? But yes, Ultratech Cement, the numbers are slated. We're going to be looking out for that and pick up the cement story once after that commentary comes in. But Anisha, thanks for joining in. We're going to take a very quick break on that note. Just revisit what the Gift Nifty is up to after that 100-point slide that I was earlier indicating. It's seen a massive recovery from there, now lying absolutely flat as we speak, 19,866 in trade. We'll take a break. When we come back, our fundamental experts as well join in on the show.
Sandeep Savarwal joins us now. I haven't interacted with him in a while, even though he's been on the channel. He was traveling, then I was traveling, then he was unwell, then I was unwell. So it's good to connect with him. So, sir, good morning. What are we talking? Infosys, what a howler, what a disaster.
Yeah, Nikunj. So I think the writing has been on the wall for IT outsourcing companies for a long time. However, I think people have wanted to ignore it because people just want to buy IT stocks at all points of time for some reason. There is a time when we need to ignore a particular sector, focus on others, and this is that time. In fact, I would think that even this guidance is aggressive from Infosys side. I don't think they'll have any growth. In fact, we might have a degrowth scenario because project ramp downs are still on, and we might see further ramp downs in the current quarter, which is going on. Say, relying on these technology company managements who change their guidance every quarter is not the right way to invest. That's what people need to realize. You need to do your own analysis. These managements generally tend to be quite bullish all the time. So I would still think that we are still some time away. Infosys at least gives a guidance so we get some clarity. Other companies just talk esoteric terms which you need to decipher yourself and which becomes tough. So I think the entire industry is going through a phase of transformation which will take some time.
Absolutely amazes me that how the commentary has changed in just 2 quarters. TCS used to be reasonably confident about a double-digit growth, and they would use words like all is well. But now, double-digit growth is a tall task. Wipro, delay in discretionary spend. Deal execution pushed to FY24. Double-digit growth could be challenging. So Sandeep, now that the bad news is in the open, the question is that after today's fall, let's say Infosys cracks 5-10%, is it time to now buy the bad news?
See, normally, Nikunj, we would say that, but the problem specific to the tech stocks in India is that they are hugely overowned. Every retail investor wants to buy these stocks at every small fall. Infosys is the most owned stock among institutional investors. So, do these investors at some point of time take a call that this is not the sector or stock to be, and we should be somewhere else? So, I think that's what will determine where the bottom formation will happen. So, people have been trying to buy the bad news now for the last 2 quarters. Uh, Results come, stock falls, people think worse is over, they buy, pull up the stock, and then the results become worse. So I would like to wait it out. Let's see, because see, we don't have unlimited money, right? So there's a set of money we have, which we need to invest in a set of stocks which we think can do well. Now, technology stocks at this point of time don't fall into that category. 6 months down the line, we don't know.
Historically draw up data on Infosys because Infi typically has, and more than TCS and other IT majors, has a habit of reacting, on extreme end of the curve on its earnings day. Big moves up and big moves down as well. Today, of course, goes without saying it's going to be a big move down. But historically speaking, how much has Infi fallen on guidance cut days?
Yeah, I'll tell you a very interesting thing. 2010, 11, 12, I remember because that was a time where I used to trade options for Infosys. And it was a special situation because the results used to come out. the IVs for Infosys at that time was around 34 to 36. So if the IVs pre-result was say somewhere around 24, 25, we used to go long on IVs expecting that the IVs would climb up. And at 36 plus IVs is where we used to create shorts. And the reactions post results for Infosys at that time was around 10% kind of an average gap up or gap down. So, irrespective of the direction, we used to expect that the IVs used to shoot up to 35 plus levels and then it used to cool off post results coming back towards 18, 19. But what has happened this time around or over the last so many years, 5-7 years specifically, is that the IVs for Infosys is on an average 18 to 20% itself. And that's why we've not seen any major sharp reactions for Infosys post results. So the average range for Infosys post results, if you ask me over the last 3-5 years, would probably have been just in 3 to 5% kind of a band. But this time it could be a change where you might see a change of reaction coming back into Infosys. The IVs are still in the range of 20 odd. The open interest has dropped down. In fact, I was looking at the data over the last 15 days. From a 4 crore open interest start of the July series, till end of day yesterday, we were at 3 crore open interest, which means already a reduction of 1 crore of open interest. So traders were going in extremely light into Infosys results. So even that would probably shield the sell-off into the stock price. But nevertheless, I think we can expect that the stock would probably cool off by at least 5 to 10%.
Yeah, especially given the pre-positioning on Infi. I was just looking at the 5-day change. It's already run up almost about 10% ahead of the numbers.
The entire IT sector got into confidence.
Okay, Sandeep, while we are talking about Infosys, the surprise actually, frankly, is L&T. A company which nobody expected could actually consider a buyback, considering that their business is in a natural uptrend and they would be needing capital as their capex cycle is growing. They are considering a buyback. And just for the benefit of our viewers, if a company is considering a buyback, that means they're confident of free cash flow. That means they want to reduce their equity and they want to reward shareholders. So what does this buyback from L&T mean, Sandeep?
Yeah, Nikunj, actually, it's quite surprising and came as a surprise to me also, although L&T on the large cap side is our top holding because of the fact that the stock is at a high and company announcing a buyback at that price is intriguing to say the least. So, like you said, they would be very confident about their growth, their cash flow, and the need for capital, and that's why they'll be doing it. And I think there was there's some mention of a special dividend also. So I think the read through prior to the results seems to be quite positive from L&T. Let's say what comes out in terms of result and guidance, but overall, like you said, very surprising.
Yeah, that it is, and that's going to be one stock to really look out for, as would be many others, and so many earnings reactions coming in this morning. There's, of course, going to be Unilever as well, given that the volume growth at 3% is definitely quite below the street estimate, because the street was averaging around 5 to 6 odd percent. Sandeep, does it come in as a surprise as Unilever's volume growth is a miss?
Oh, sort of, but I think it's 1 or 2% here and there. It doesn't matter so much. But the stock is expensive, right? Because a company going at 5, 7, or even 10% trading at 55p, tough to justify. So I think unless the volume growth picks up significantly, which some of these companies seem to be indicating that demand has picked up, like some consumer durable companies also, which I heard post results, they seem to be indicating that June seemed to be better after subdued April, May. So if that's the case and it picks up, then the stock could hold on. Otherwise, the stock's not really cheap.
Okay, I'm just looking at United Spirits, and that has really been the positive surprise this morning. So let's just bring up what the stock, of course, has done and what the earnings are looking like if we have the Q1 update there. The Q1 revenues have been above estimates, and a volume growth of 10% on a year-on-year basis definitely is a big beat coming in. Kunal, you track the liquor space pretty closely, both Radico as well as United Spirits. Big move today, you think, after the numbers on USL?
Yeah, I think it should be a big move, and the way the stock was setting up this move over the last 3-4 months was also quite exceptional. We've not seen United Spirits getting into a trend over the last 3-4 years specifically, because every time the stock goes into a 5 to 10% kind of an uptrend, it used to be met with a major time-wise correction as well as a price-wise correction. But this time around, the trends have changed significantly for United Spirits. The stock had already broken past about the 2022 high, which was around 930 odd mark, 2021 high, which was approximately a 950-55 mark for United Spirits. And I think the all-time high levels for the stock is around 1010 or 1019. For itself, which means another 40-50 rupees on the upside, and we could be looking at the stock making a fresh high. So the way in which the stock had approached this time was completely different as compared to the previous last 2-3 years odd. So I believe that this time around the breakout should sustain for United Spirits. Looks very attractive on the charts.
All right, there you have it. That's United Spirits on the charts, but it's time for stocks on the editor's radar. And let's get cracking with all the heavyweights today. We'll begin with Reliance Industries. It, of course, has been in the spotlight of late, really due to the demerger of the financial arm. And let's talk about what's working in its favor, Nikunj, and what the key triggers down the line are for RIL now at all-time highs.
So, Avan, Reliance Industries has been a special situation stock largely because of the unlocking and the price discovery of Jio Financial Services. Now that price discovery has happened. That's about 260 rupees, north of 260 rupees. That price discovery has happened. What happens next? Well, back to basics, because the markets a year ago were not exactly expecting this kind of a price discovery from Reliance. So that has come like a bonus, and that has come like an hurrah. And institutional investors who think 5 years, 10 years, if they want to, who want to buy this new business, they piled up the Reliance stock. What happens now? Well, back to basics, which is that if you really look at the core business from Reliance, in terms of their Reliance stock in this year, frankly, if you take that extra part out, has done nothing. That's largely because you will have to go back to the core business.
Flat year today.
Flat year. It has to go back to the core business. In terms of the core business, the Jio business, you don't know tariff hike when that will change. The old economy business or the OTC business, it will see a sequential decline, and retail business is growing. So there is no zing which will, in a sense, ensure that independently of this trigger of delocking, of the unlocking of the Jio Financial Services, there are triggers which will generate upside momentum. But there's an AGM around the corner. So you could see some adjustment in and around the adjustment. Retail excitement is normally high, but purely fundamentally speaking, I guess Reliance now will be back to basics, as the core businesses do not have any extraordinary trigger, at least left for FY24.
Yep, and it's the one we'll be watching out for as well today closely. But moving on then, let's discuss ITC and HUL, the FMCG majors. And just if we were to compare both of them in light of the fact that HUL came out with its quarterly numbers, do you think that there is some sort of a competitive advantage when it comes to ITC?
So I'm comparing apple and oranges here. You cannot compare HUL and ITC, but the reason why we are talking about HUL and ITC here is that I guess ITC has moved on a completely different plateau in last 1.5 years. The same stock which was getting a stepmotherly treatment largely because of what was happening in terms of because of tobacco business. I guess the FMCG business and the hotel business has come for rescue. The outlook for the hotel business for ITC has not changed. Outlook for the tobacco business has not changed. What has changed is the fact that there could be a possibility of unlocking of the hotel business. That is not the case for HUL. While institutional investors and retail investors have started moving out of HUL into ITC, I guess the trend is real and its trend is here to stay. Both in terms of valuation, HUL is at 55 times, ITC is 28 times. So it's expensive. No triggers. Volume growth is not there. Institutional investors who've been trimming the exposure to HUL, moving into ITC, I guess this will continue. So I will not be surprised that the performance of HUL, and we are looking at almost 6 months of performance, 7 months of performance, ITC of 50%, HUL of 5%. I guess this performance is just going to extend itself, where ITC will outperform HUL, and I think the curve has just about started.
Okay, the curve has just about started. That's ITC versus HUL. And Aisha, we've got an ET Now exclusive as well lined up.
Oh yeah, absolutely. We told you just yesterday that we're learning from our reliable sources that ITC is all set to announce a demerger of its hotels business, and that's going to come in perhaps even before its AGM next month. Winnie is here with all the buzz that she's picking up from her sources.
So absolutely, what we have been hearing always is about the demerger of the hotel business of ITC, and now we are expecting that announcement to be made as soon as in the next month. This is what we are picking up from our sources, that the likely announcement is expected to be made ahead of the AGM, and that is going to be on 12th of August 2023. Currently, obviously, the hotel business contributes to around 4% of the SOTP valuation in terms of the overall ITC valuation. And let's not forget, ITC overall also has been focusing a lot on increasing that asset light strategy. So it works in place, to demerge the hotel business and get some value unlocking over there as well. Brokerages as of now are valuing that hotel business at 20,000 to 25,000 crores as well. Currently, in terms of when you look at the hotel business over the last decade, has contributed around 5% of ITC's revenue and EBIT, while it's the second largest hotel after IHCL when you see, and EBITDA margins of ITC in terms of the hotel business is almost at par with IHCL as well. Currently, they have 11,500 rooms across 120 plus hotels and 70 locations is what they're spread at. We have always had that commentary coming in from Sanjeev Puri as well, time and again, and July 2022 is the first time when they spoke about the demerger of hotel business again, and they said that it's very much on the table again. And to an interview to ET Now exclusively, Sanjeev Puri also highlighted that alternate structure of the hotel business is on the table. Annual report 2 is highlighting similar commentary that they're committed to that asset light model and structure of this, and obviously creating revenue streams and alternate structures for strong industries is something that they would look at. So now we could expect this demerger of the hotel business, given that the market currently is trading at an all-time high. We are seeing that it's an opportune time to make this divestment as well, and hotels as a sector has seen a sharp recovery post the pandemic and has recovered very strongly. So right time is what they feel could be coming in for ITC's hotel demerger, and this is what we're picking up from the sources that we could see is as early as in the month of August.
All right, thanks very much for giving us those details. In fact, let's take it across and continue our conversation with our chartist as well as Sandeep. And Naresh, I actually wanted to come to you on the charts, talking about some of the stocks that were in the spotlight on the upside yesterday. You had an ICICI Lombard that did manage to stand out on the charts, and even something like a Tata Consumer. What are the charts indicating?
So ICICI Lombard has finally taken out a one-year range. The recovery has been sharp from 1100 levels where it consolidated for the whole of March, April, May. And now the trend is slowly and steadily up. The last time it came to 1350, 1370 level was in March of last year as well as August of last year. So clearly the trends are up slowly and steadily. The stock could head up higher. A stop loss now would be placed closer to 1330 levels and expect a move slowly towards 1500. So the trend is positive here. Going to Tata Consumer, that's also an interesting chart. Back to the highs where it was for the last almost 2 years. It topped out around 890 back in 2021, then in closer to 860 in 2022, and we are back to 860, 870. Could take some pause before it can actually break out. So would wait for some more time, let it consolidate here between 850 to 900, and then maybe take a call after a few weeks if it can break out.
Sandeep, I want to talk to you about Havells, considering you tracked this one closely. What did you make of the performance? While some of the brokerages are giving a mixed reaction, CLSA has downgraded the stock to a sell from the earlier underperform, cut their target prices as well. But Lloyd continues to remain a big drag.
Yeah, so overall results were mixed, but not something which gives a fillip to the stock price in the near term, obviously, because of the fact that across the board, sales momentum was not as good as what we could have expected. And the company did indicate some improvements going forward, but valuations are very high. So if you look at valuations of Havells, it trades at around 55 times earnings at a time when earning growth has been subdued, and they are actually pushing more on advertisement, promotion, etc. to push sales when consumer demand has been subdued. Good part for many of the consumer industries is that channel inventories are reasonably low or moderate, and to that extent, if there's a pickup in demand post monsoons, then these companies could benefit. At this stage, there's no reason, I think, to buy the stock at this price.
Do you profit take here, given that there will be some foreseeable pressure on the stock?
They could be forced, there could be pressure on the stock, but I don't see a big cut per se. So I think there could be some cuts, but so I would say that people who have been holding for a long time, the stock has done well for them. They don't need to sell for a 10, 10, 12, whatever percent downside. But whoever is looking to buy afresh, I think they should wait it out.
Sandeep, there's also Aurobindo Pharma in the spotlight, and the company, as per Economic Times report, is eyeing a $5 billion revenue over the next 5 years. Any stocks that you track within this space, Aurobindo in particular as well, on the fundamentals?
Aurobindo, unfortunately, I cannot understand. But I think on pharma, we own Sun Pharma as a holding, which we are holding on, and I think the company is doing well. And Lupin is something where we have taken a contrarian bet of turnaround. It's done reasonably well over the near term, but stock still 50% off peak value. So if the turnaround sustains, that could do well, but then there are risks inherent in that also if things don't pan out the way we think should turn out.
Some of the other names which are going to be reacting to their numbers, we already flagged off United Spirits. Look out for that stock. That's where you're going to see a big move perhaps. But India Mart as well. The EBITDA has jumped up almost about 20.5%. The board has also okayed a share buyback of about almost up to 500 crore rupees. So this is going to be another stock to look out for. India Mart is what I'm talking about. That stock will just come off for you on your screens. Sandeep, this is one of the haloed stories of 2020, if I can recall. You know, when the fad was some of these internet companies and, you know, some of these platform companies, if you will. The story didn't quite play out as well in the preceding years. But what did you make of this earnings performance if you track India Mart at all?
Yeah, I've been tracking it. The performance is reasonable. We can't say that it's extraordinarily good because the reported earnings obviously include some other income and all. So if we look at core operating profit growth, it's around 20%. So stocks not really cheap from that perspective. So it's a very different company from other internet at sector companies because it's a cash generating company. Unlike many others where there's no cash generation and cash generation could be some way off. So to that extent, it's a different company, but at these prices, it's not really cheap. The buyback announcement could provide some support to the stock, but otherwise, it's not really a cheap stock at these prices. As the growth rate, which was envisaged a few years back, that it will continue to grow at 30-40%, that has moderated significantly.
You know, apart from the companies that came out with their numbers, we'll be watching out for Reliance Industries, of course, today. Then there's Ultratech, JSW Steel, the likes of an Ashok Leyland, 197 DLF, etc. that will all be coming out with their quarterly numbers. And I was curious, Sandeep, to get in your thoughts maybe on the cement pack, Ultratech Cement. We're expecting this time around that it could be revenue growth in the quarter. What is it that you're working with when it comes to earnings for the cement sector?
The cement sector is a very mixed picture because the companies have not been able to increase prices, and to that extent, it all comes down to cost management. So, whichever companies have seen volume growth and better cost management, they might actually do much better than others. So, like for Dalmia Bharat, results were average, but Ultratech volume growth this quarter was quite strong, and they have been showing good cost control. So I think they could report reasonable numbers. Only risk for the cement sector is that supply increases are rapid, and to that extent, the companies are not getting pricing power despite volume growth. And once the input cost reductions play out completely, beyond that, to grow earnings, you need pricing power, and which looks unlikely for the near term. So I would think that it's a risk reward is balanced. I would not be a buyer in Ultratech at this stage unless and until something totally surprises completely positively.
I want to go back to PSU banks. Kunal, fresh breakouts have happened, at least in Can Bank, SBI and BOB also. PNB. For a trader, is there trade there?
Yeah, for a short-term trader may not be a best trade, but I think from a positional trader, I think it's a very good trade because So, what has actually happened is from 2022 second half, September lows or August lows for many of these PSU banking stocks till the end of 2022, I think the first week of December 2022, these stocks had run up on an average 30 to 40% in many of these PSU banking names. And post that, these stocks went into a 3 month of consolidation. So these stocks retraced, some of them retraced 10%, 15%, even 20% for a few of the high beta stocks. And now these stocks have made a comeback. So when you look at this three-step move, in initial breakout, a very powerful breakout for these stocks, then a retracement or a consolidation, and then a second round of breakout, which means what we are looking out for is a multi-month, multi-year, multi-quarter up move for these PSU banking names. The only odd tendency for these PSU banking stocks is that they get into that exaggerated phases of overbought very, very soon. And if you try and time the stocks when you're looking to buy it on momentum, you could be left out buying these stocks at the higher end of the price curve. So it's always better to wait out for mild correction to buy these names. But I would strongly believe that there could be a new cycle which could be on the bullish side for PSU banking stocks.
Sandeep, there is little merit in trying to say that the future winners would be from the PSU banking space. But in the near term, given the gap, momentum and the sheer underperformance which PSU banks have had over the years, is there a tactical trade there?
Nikunj, this is very tough to call because of the fact that we are entering into a tough cycle for PSU banks now. So they have cleaned out the balance sheets. Balance sheets are very clean and all that. And once when interest rates were low, they could boost their NIMs, etc. Now we are entering into a phase where it's going to be deposit competition, and in my view, the large private sector banks are going to win there. So the margins are going to get squeezed now. But so if they're able to maintain their asset quality sustainably for some more time, then it's possible they'll still perform. But I'm skeptical on their ability to retain their market share in the bread and butter CASA deposits, and that is what will distinguish between banks.
You know, the one stock that you can't take your eyes off is Polycab. Sandeep, I don't know if you've been tracking the story or not. It's a recent listing. Since then, it's really been on a tear. The numbers were phenomenal. Investors, even if they, bought into IPO or even after that, are still have, doubled their investments from there. And it continues to move from strength to strength.
Yeah, Polycab, again, it's been one of the companies which has been very surprising in terms of the way they have done, because largely 90% is cable and wires, and even there they've been growing much more aggressively than any other player, and also showing margin improvements, etc. When the rest of the sector has not done as well. So some companies have, some haven't. So surprising. We had some holding in this stock at some stage, but we sold it off. So not holding right now, but I've been tracking the results and their calls, etc. So the company has been doing well.
Since we are discussing Polycab, the eyesore there actually has been Havells, and Sandeep, they're in the same business.
We just discussed Havells with you.
We've discussed, okay. Yeah. I was out. So sorry, I must have missed it. I'm going to, shift from there and talk about a stock which in a sense has been the real darling of the market, and it is coming back. That's TTK Prestige, Kunal. It's above the 200 DMA.
I haven't tracked the stock, frankly, Nikunj, for a while.
Okay. Sandeep, is there merit in buying consumer durables and consumer discretionary stocks now, given that the interest rate cycle is peaking out?
Durables, yes, but then in the near term, we've seen some rally, like we saw a rally in Havells and other stocks also. So I think in the run up to the festival season, we should. So what is the best strategy is tough to define. So we keep on accumulating slowly or try to time it more near over the next couple of months is something we need to see. But the story overall for consumer durables should definitely improve.
We'll let you go on that note. Good to have you on the show as always. The pre-open rates, not as much the Nifty, but I want to see what's actually dragging it lower, and definitely it's got to be IT. Let's bring up Infosys after that guidance cut to 1 to 3.5% versus the 4 to 7% band earlier. Infi is a gap down of 10%. Not surprising there. you did expect this kind of a steep reaction on Infosys. 1300 is where it's currently trailing at. And just a reminder, the ADR as well shut shop lower by nearly about 8.5% lower. And I think at one point in time, it was down even double digits, 10% lower on Infy. Now, is that really rubbing off on the rest of the IT pack as well? Consisting it's a bad performance from Persistent. The TCV has fallen 10% on a sequential basis. So it's not Infy alone, but Emphasis as well, wherein the BFS revenue is lower by 8.8% on a sequential basis. So poor performance from some of the other mid-cap IT names as well, like Persistent and Emphasis. But what about the large-cap IT boys? What's TCS up to? What's Wipro doing? HCL Technologies? They will all come up for you on your screens next. And it's a big rub-off and a drag on some of the other large cap players as well. HCL down 4.5%, TCS is down 5.5% at a time when Infy is dragging lower by 10%. I just want to quickly check in on Reliance and then, of course, L&T after the buyback announcement and United Spirits as well, because these are stocks where you will see a steep reaction perhaps. 1% higher for L&T, USL is up 2.5%. So yeah, bracing ourselves for a bit of a step back finally, not just a halt, because the Nifty is now at 19,500. Maybe that's a little bit of an exuberant reaction coming in. 1% lower what the Sensex is at looks a little more believable right now. But Kunal, what's on your mid-cap radar?
So yeah, from the mid-cap end of the market, I would suggest one of the stocks which I've been recommending earlier. That's a buy on Paytm, because that's a stock which I think has headed towards a breakout. Fresh 845 plus, I think, if I'm not wrong, the stock closed yesterday above those levels. So would suggest a buy, expecting a fresh up move for the stock. 880 plus could be a target, 885 to be precise, and stop loss could be kept at 834.
Okay, let's get in your top recommendation from the mid-caps, Naresh.
So looking at NHPC, the stock is a defensive bet, but technically the stock has broken out of a 6 to 8 month range. A classical breakout, 39 used to be the bottom end of the range, 47 was the upper end. You could call it a channel breakout or a cup and handle breakout above the 47 mark. Would give a quick target price of 55, a stop loss to be kept at 46.
Yeah, we have a 10% down on Infosys. That's the maximum you can go down in the pre-open session.
Yeah, 10% is the first circuit.
Yeah, and the pre-open session, the price discovery will happen by 9:10.
9:10.
Okay,
so it should stop at 10% only. But I think once the stock opens at 9:15, after I think a gap of few minutes, the circuit opens up and then the stock is allowed to fall down.
What is the worst case scenario for Infosys? I'm not trying to scare anybody here, but we are discussing it.
No, I think the worst case scenario, I'm not sure the percentage loss it could be, but in terms of charts, maybe 1300 and 1250, these are the two supports for Infosys. 1300 seems to be, on the verge of breaking out at the open itself. The next level of support should be at 1250 mark. The concern for such kind of trades, Nikunj, is that there are intraday spikes on the downside which happens for the stock, and those spikes, they tend to break those support zones. So stop losses get triggered, position starts to get unwind for stock prices, and to exit the stock becomes a lot more difficult in such kind of a sharp or a severe gap down.
And I'm going to first ask the same question to Naresh and then we'll talk about Reliance. Naresh, what is your view on Infosys? What could be the worst case scenario?
So the worst case scenario, it goes back to 1250 to 1280 levels, which is where it gapped down on the last quarterly numbers and then created a base. So the whole up move, thanks to TCS and other numbers, should fade off. And say before this numbers, the stock was at 1320. Given the case of it, I would expect 1250, 1270 as the worst case for the stock.
10% down for Infosys. Now the question is that do you go and buy Infosys? Because 10-15% lower, Infosys then reaches what could be called as in and around its 5-year average. Ravi Menon joins us, represents Macquarie. Ravi, good morning. Thank you for joining us. Okay, we are in for a bit of a bouncer for Infosys. Nobody expected this coming. But now that the bouncer has come, what should one do?
The risk reward is still unfavorable. We think the firm has actually not scaled up to the quality of the peers in terms of how it takes on outcome-oriented deals. Apart from Daimler, we've actually not seen them take on these kind of large where the vendor assumes the risk, and in return, this amount, and that allows them to make. We've seen HCL and TCS do a lot of these deals, a bit too risk averse back then, and it's not built up that risk management capabilities, too well. And that's, I think, what's hurting them now. And when we look at the guidance, I'm a bit puzzled because that then suggests that the deal wins that they've had are more renewals, that including the $2 billion framework deal that they have announced. Seems to be more of a renewal rather than net new business.
Hi, morning. Just going by, the latest note as well on Infosys, given the fact that there was that mega deal as well that took place, the report describes it as not a mega deal because it's merely an estimate by the management. Can you just elaborate a little bit more?
From my time in the industry, I've never seen anyone talk about a hard revenue number attached to a framework deal. Typically, you have the client might be spending on a regular basis, and perhaps that's what the management has assumed that now they might be one of the main vendors in this stream of work, and therefore this is what the client spends on that, and over 5 years, this is what they might get. But that number seems very high to me. I think that this might be more the top end of what the client might intend to spend. Probably the management thinks they can get there, but I think given environment as well, I think probably the entire budgeted amounts, I don't know if clients are actually spending that.
Infosys, more like a company-specific issue, or this is really like a canary in a coal mine? What Infosys has indicated, others perhaps would be walking the same path, whether it is TCS, Wipro, HCL Tech. It could come earlier, it could come sooner, but everybody will have to walk the same path. That's my question. Why are you smiling, sir? Looks like you preempted my question.
No, I think that it's a very fair question, and that's actually in a different league when it comes to mega deals. They've got the expertise and the track record doing this, especially in the infrastructure management services side, where I think that's a incredible asset to have. When people are looking at cloud migration, some workloads, critical workloads, are remaining on premise. And so that data center management expertise becomes critical when awarding new deals. And I think that puts TCS and HCL Tech ahead of Infosys in that regard. And why we think this is more Infosys specific, because I think they have done really well in terms of creating the right skills when there is a need in the market for that particular skill set. That's something they excel at. But I think that's why they get, I think, more impacted when the economic environment is less certain and these kind of discretionary projects get cut. So that's, and they're not able to win the large cost takeout deals which are outcome oriented. The deal that they won with Danske Bank, for example, that's they're buying the IT captive of Danske, and taking over the employees there. So there is no assumption of risk really here. If you're not taking on risk, then there is really not much reward there to be had in these sort of mega deals. And that's what we would call a true mega deal.
Ravi, we've got you on a terrible line, but such a lovely point what you've made in terms of deal size and the risk reward ratio. Good to have you back, and lovely to have you on ET Now today. That man's been tracking Infosys for 20 years now. I've known him both.
This man too.
24 years now. 24 years now. We don't realize, but when I started my career in television journalism, Infosys had a quarterly profit of 60 crores.
This man too or no?
14 years.
14.
What about our ladies here?
Well, Infi right now is not down 14%.
We're not talking about age. We're not talking about age. It's okay.
I just started tracking way after you actually.
Yeah.
129 points lower, 9% lower is where Infi has settled in at in the pre-open rate. And the unfortunate part is that it's rubbing off on the rest of the IT pack too. Yes, while the Nifty may have settled in and it's no more that steep cut that the pre-open rates were indicating, but it's definitely going to be a step back. I mean, to think of it, we were only 20 points away from 20,000 yesterday. That's going to definitely put a step back.
Assignment is calling everybody back from dealing rooms. It's sent to celebrate 20,000 on the Nifty.
Yeah.
Kunal, will it happen today?
20,000?
Yeah.
Unlikely.
No, it could be Reliance, it could be SBI, it
But
could
then
be
you have to
HDFC
offset
Bank.
good gains. I mean, Infosys, the 10% drop could probably lead to a 100-point drop on the Nifty.
It's almost a 2% move on
the
TCS,
percentage
HCL
weight.
Technologies,
Ripple
all
effect
of
And
them.
the ripple effect to the other IT stocks would also add
Can
to
be
that.
seen already.
I think we are talking Infosys today, but trust me, we'll talk Reliance next week.
Yeah.
Because Reliance, that's a special price
the
discovery.
upside.
See,
Or
Aisha,
downside.
I think Reliance core business is not firing full cylinders. This price discovery of 100, 250 rupees has become, it was like a bonus. It was like a freebie which frankly nobody expected a year ago. So that 250 rupees, thank you very much, and that has led to a surge and that has led to compulsive buying. But then you got to go back to the core business because this business has just got incubated. And what is the core business? Energy. New energy is still a distance away. Then you've got Geo, where price hike, we don't know where it is happening and it's becoming very competitive there because price hikes are not happening now. And then retail, which is just chugging along very smartly. So for Reliance now, the trigger in the near term, which was the price discovery, I think that is over. So the management has been very benevolent in giving shareholders a reward. But now for the existing stock to go higher, it will be a function of flows largely from ETFs rather than a derived factor of earnings. You know, you will buy Reliance because it's part of Nifty and part of India. You will not buy Reliance because there is something special which is expected there. That's my limited point, and that adds up with numbers today. So now that suspense and that excitement from the Reliance stock which got created once the book value was announced, I guess that is behind us. That's where the Reliance stack is. So Naresh, tell me the risk reward ratio now. For Reliance, post the demerger, or post the demerger of the price of the Jio Financial Services, and Infosys after today's fall. So I'll say it again. Reliance, now that the event is out of the way, and Infosys after today's fall.
So Reliance would be a better pick. Technically, the stock came back to 2850, which was the previous all-time high. Considering 250 rupees off from at 2600, I would expect 2500, 2550 to be a support zone, which is where you want to buy on a dip. So closer to 2550 is a buy on Reliance Industries. And Infosys, if it drops down to 1250, then maybe have a look at it. Else it could continue to go sideways, which happened last quarter also. After the big gap down, the stock went nowhere for almost 2 months. The stock gapped down at 1250 and it was at 1250 back in June as well. So April to June, the stock went nowhere. It was at 1250, 1300 mark. So today, if it gaps down to 1300, there is no risk reward as such. It could just stay there at 1300 for maybe another month or two. So no point going into Infosys, but Reliance could look interesting on a dip to 2500, 2550.
A minute to go. So Naresh, should we wait, tell our crew to wait at the dealing room with the hope that the second half of the day we will have a touch and a go moment on the Nifty at 20,000, or should we call them back?
I think we should call them back.
Kunal?
Yeah, I think
I can't send them again because Bombay is raining in Bombay. So please decide and tell me.
I think we should call
You
them
sure?
back. Yeah, looks like.
Okay, we'll take your advice.